Live streaming is on.
Good afternoon, trading community. It's that time again where we will host our trader strategy meeting. If you happen to be new to the service, this is where we get our team together and discuss some themes that we may be seeing over the course of the coming month. And of course, we've seen a lot of volatility since our last meeting, and a great person to talk to get some top level perspective is none other than chart trader Brett Manning. Good afternoon, Brett. How are you?
Hey, Jim, I'm doing good. How are you?
I'm doing quite well. So, you have been no stranger to taking on some shorts in this market. And in fact, you've been pretty bearish over the course of the last few strategy meetings. Why don't you give us a summary of your outlook now and why you found it so compelling to take some short ideas?
Over the last couple of maybe the last, say, three strategy meetings, I've been making an argument for being bearish and seeing this as the potential turn toward a genuine bear market rather than a consolidation in an ongoing bull market. And there are a few reasons for that, but you can sort of boil it all down to a combination of inflation and deleveraging, and really how that dovetails with the correlated idea that we've transitioned to a new paradigm where there's no Fed put and there's no money flows coming from fixed income translating across to equities on dips, which is something we've seen over the last decade and a half. Because every time we see that, you get this phenomenon where the dividend yield on the S&P falls or rises above, 5, 7, 10-year bonds, and you get this money flow across from a lot of people who just need to get a return, pension funds, sovereign wealth funds, etc. And so it's been this kind of there's been this Fed put and this dividend yield put that have been sitting under the market for a while. And the transition that we're going through right now has removed both of those completely. And I think you can kind of boil it down to that. But uh, I want to kind of summarize it this way: if there's anybody out there who still believes that this Federal Reserve is just about easy money and is just bluffing when they say that they're attacking inflation, whatever it takes, you're living in a fantasy world. The folks on this Fed came of age in their careers in the late 70s, the early 80s. Volcker's legendary inflation battle was pretty much their formative experience. Inflation was a huge problem, plagued all the 1970s through multiple cycles. Powell was just coming through grad school at that point, looking for a job. Volcker hiked enough to stamp it out, and he didn't care if he took us into two recessions to get the job done. And that led to nearly 4 decades of disinflationary growth and unprecedented prosperity. That's what Powell knows. That's what Harker knows. That's what Mester knows. That's what Bostic knows. All of these people kind of had that same formative experience. And I think that that really plays into where this is headed. And I've felt that all year. But inflation right now, it's being driven by 15 years of chronic underinvestment in raw goods. The ESG movement's partly to blame for that, but coming out of the pandemic and deharmonizing supply chains is a huge problem, and that's sticky. And that means we could continue to see high inflation even after we move into a possible recession. And in that case, we may be moving into a recession and seeing a Fed that keeps hiking rates. And that's basically what I felt all year. And I can't really imagine when we were talking in December, I couldn't really imagine how there could be a worse situation for equities than that situation. And I think that people are starting to realize that at this point. And so we've gotten going with the sort of self-reinforcing feedback loop that defines cycles that I described in that Turtle Beach metaphor that I posted a few minutes ago. There's people go into their shells, it makes the environment worse, makes people go more into their shells, it makes the environment worse until you play the whole thing out. And the other reason I've been bearish is, and we've talked about this too, is simply I believe you can't have such a complete sea change in the interest rate paradigm after such a long period of ZERP and QE and cheap leverage without something breaking, because you've got so many people over the last 15 years who've acclimated into careers and they're managing large amounts of money and they have no idea what another environment looks like. And they understand how they're going to, ramp up their leverage to take advantage of really small spreads between different interest rate products or whatever. But something in that situation, when you transition that dramatically, something's going to break. And it could be a big fund blow up. It could be some, arcane corner of the credit market that all the banks are soaked in and nobody really notices until suddenly people identify it as a problem and that's too late. I don't know. But I would guess that story is still out there and still probably in front of us. But that said, I mean, we've come a long ways over the last few months. I was really looking for a big flush under 4,000. We got a big flush under 4,000. Nasdaq under 12,000. We got Nasdaq under 12,000. ARK has completely blown up. It's a total Christmas tree on the weekly chart. And so it's possible that we could see some kind of change that swings things back around before too much longer.
All right, Brett. My logical question for you at that point is, what is a real catalyst that could propel that change? What would change us into a bullish tone other than I would think that maybe there's some people who are just completely off sides? I know that that's a dynamic that we have to consider and that will be prevalent in the market. But as far as a specific catalyst, what is something real and tangible that could change the dynamic of the market forces?
Okay, so when we were in our December meeting, we were doing sort of a year ahead outlook. I said there was a possibility of a Goldilocks year this year, even though it seemed really unlikely to me. And the one factor that I thought could swing everything around, and this is well before, we definitely knew that Russia was going to invade Ukraine and all of the sanctions and all of the limitations on wheat and oil and everything else. But just where we were then, seeing this lack of Fed put situation, it was already there. But what I thought could swing everything around then I still kind of think could be a much bigger factor than people realize. And that would be China finally giving up on zero COVID as a strategy. Just giving up on it, just saying, listen, this is not going to work. It's not going to work against Omicron. We're not going to be able to prevent the spread no matter how many lockdowns we do. Because the path they're on right now, obstinately, is I mean, it's a disaster for growth, but it's also a disaster for inflation at the same time. It's like the
Mhm.
perfect stagflation driver. They make up such a huge sort of swing piece for the global growth pie. Huge. When China's got a problem, it's a problem for everybody. It's not only because of how much of a share of the global economy they have, it's how much of a share of the growth picture they have. Because it's the second biggest economy, but it's growing still over the course of any given 5-year span recently at much higher level than some place, like Europe or the United States. So the growth picture is really defined a lot by China. And also it's so many key supply chains are like rivers that flow from China. And so if they're in lockdowns and their ports are stagnant and they're shutting down factories and everybody's, fenced into their apartments with drones flying outside and guns around, you're going to get more inflation. So you got this stagflationary driver that's sitting there. And if China were to just give up on zero COVID, it would be a few months of massive caseloads, and then it would start to peak and die down like the rest of the world already has. And I think that could be a big factor the market would start to discount in as taking pressure off the Fed and starting to show us peak inflation and possibly really turning things around. And the other possibility, aside from that, would honestly be if this very orderly decline turned into a very disorderly decline. We got the work done fast in terms of getting things that are really high quality names to really genuinely cheap levels.
Okay. I just want to touch back on the inflation story. And you were long gold via the GLD. And considering we have the high inflation and very nervous markets, wouldn't you think that would be when gold would shine the best?
Yes, but I would also say that historically, gold really only moves in a way that's correlated positively with the US dollar during panics. And this has been an orderly decline, and the dollar has been just blasting off. And until that changes, it's really going to be difficult for gold. I mean, the dollar's move is really so. There's interest rate spreads, probably one of the main reasons. There are a few reasons. Interest rate spreads are a big factor, though. The United States has interest rates way above where they are in Europe and Japan. You can borrow at nearly zero in euros and yen. You can lend to the U.S. government for 3%. You can pick up the spread. So money's just flowing from other areas into the U.S. The other one, the risk parity model is blown up. Stocks and bonds are supposed to move in different directions. They're moving in the same direction and it's down, which means the $1 trillion that's in risk parity models is basically moving to a higher percentage cash holding because neither one of the barbells is working. Um, and people are deleveraging. I mean, you could think of somebody selling a share of a stock as somebody buying dollars with stock. Cashing out is buying cash. So you've got these different aspects of it, but they're resulting in a huge dollar bull market. And even with inflation at 8%, and I would also say the Fed story is important. Like knowing that they're basically going to say, even if we have to take things into recession, we're gonna beat inflation. That's not a gold positive story. If they were to shift and suddenly you start to hear Powell saying, you know what, 8% CPI is not so bad. We don't want to risk job losses. Gold would shoot through the roof.
Mm.
So it's that bearing that's becoming clear from the Fed that they're willing to drag us through a recession to prevent the next 20 years of being like the 1970s were. They want to stamp that out and change the model and move things forward, even if it means a little pain over the next year or two or 6 months or whatever it's going to take. But I think if that philosophy were expressed differently, that would be a big impact. So it's really the dollar and what's becoming clear about the Fed's bearing.
All right, I'm going to bring Event Trader into the discussion. And Gavin, we talked a lot about the inflation story. However, we have seen markets crater to what is maybe oversold territories. I would just love to get your refreshed take on where we stand in these markets. And here we are with a nice bid in the overall broader markets. We've got Nasdaq up nearly 4%, and S&P are up what, well over 2%, nearly 3% now. So have we seen these overall conditions, or do you think this might be squeeze?
Well, I think that we can pretty clearly mark this recent decline back to just post-Fed. If you a lot of the charts that we've been looking at, you can see that May 4th, May 5th collapse down, and that seems to be what's getting bought here. Certainly, some of the more oversold names people are moving back into. I've just got an alert here with Apple getting back up to that 148 level, and I think the big thing for just trying to reclaim some of the territory is for us to get back up to that May 4th, 5th period in a lot of these charts and get that recovery in. And that's going to be the big test for the markets. But it's going to be very difficult for us to get back above that level, I think, in the coming weeks, just because we've got a lot of April ending reports starting to come out here and a lot of retail names. And I'm expecting to see some cautious outlooks. And it's based around what I was seeing on the cash transportation index report that I posted last night, where number one, on the inflation front, there was some positive developments there. They talked about a deflationary environment coming up from freight, which has been a key story in the rise in inflation and the higher costs for a lot of people. So that'll be important to watch out. Now it's only 1 month of data, and they haven't seen a complete trend yet, but they do think that we're going to start heading in that direction. So that's something for us to watch in the backdrop. But the other thing that they did state was that they didn't see much of an impact from the China shutdowns, which means to me that I think Q1 numbers from a lot of this retail crowd is going to be just fine. However, the Q2 outlook could be a little bit more questionable because, as they stated in the CAS report, most of the impact is going to be witnessed in June and July. If you think about it, it's whatever, the 60-day window. I forget what the delivery time is going from soup to nuts from China here to the US. And that should mean that we're going to have a lot of cautious Q2 outlooks. Now, when you're looking at the companies that warned this quarter, 80% of the warnings were due to companies having issues with supply chains around China in particular. So, if it's going to be interesting to see if we get this bounce and then we get the Walmarts of the world, Target's out next week, Ross stores, TJ Maxx, Home Depot, Lowe's, all big retail names, to see this bounce coming up into some key levels and then the chance for some negative headwinds here. It's going to be interesting to see how the markets develop around that. And that's kind of what I'm looking at over the next few weeks. In terms of just this broader sell-off, one of the more interesting things, and I know Brett had mentioned something about it in one of his comments, but a lot of this buy the dip crowd has been retail money being put to work. There's really good Wall Street Journal story talking about it, where small investors had plowed in 114 billion in the U.S. stock funds through March in the S&P. This was while the S&P, of course, was in a decline. So Really curious to see this time around with this dip back with this buy the dip here. Is this retail crowd still, or is this actual institutional money put into place? And again, that's something that we should see play out as we work through some of the key levels in the charts of resistance. And if you're looking for it, basically, we had that dip from April 21st, and then a chop basically into the Fed, and then that next dip down. So if you're looking at charts, basically the resistance levels from April 21st through May 4th, that's what we're going to need to grind through to get that next level of recovery here. Certainly the arguments around valuations are starting to get a little bit closer to the bull side of things. We've got some really cheap names out there that we're going to continue to watch play out. And for now, I'm willing to jump in and play those longs. But, I'm looking at the more as rentals as owns at this point until we get some more clarification and on this recovery.
All right, Gavin, are there any names that you have on your shopping list?
I mean, I've been putting out a few of them. Certainly, some of these payment firms, because I feel like a lot of the Bitcoin crowd got flushed out here. So I'm curious to see if people are going to come running back in to there. So some of the payment names, like I said, Square, some names that I felt were chopped down as a little baby in the bathwater scenario, like cybersecurity plays, Zscaler, CrowdStrike, Hack, the ETF in total. You see a headline where Costa Rica had to shut down their entire government because um, they had a malware incident and stuff. I don't think that the spending from this side of things is going to die out soon. So I think that the recent dip in those names opens up a better buying opportunity, and one that I'd be a little bit more inclined to buy and hold just from a thematic research. So there are a few of the names that I'm looking at. Some of the names that have held up better during some of the selling certainly bear interest, like an IBM or even a JP Morgan, which I know is at 52-week lows, but some of that selling's decelerated a little bit there. So that's some of the things, a few of the names that I'll be looking at that are on my radar.
All right, Gavin. I want to bring in Craig, aka Trend Tracker, and you were kind enough to post a little preview this morning about an area that you find somewhat compelling. That would be in the nuclear energy. Give us some ideas of how to get some exposure in this, Craig.
Sure. So, I kind of broke it down the way I see it. There's really only two major producers that are publicly traded, and one is in Kazakhstan. So Cameco CCJ is the big one that everybody kind of knows and looks to. But there's a bunch of ETFs as well. One of them is definitely more conservative, more like a utilities ETF that has the nuclear energy exposure in it. But the URA is basically half of the two big producers, a little bit of what I view as the best speculative developmental stage producer in NXE, next gen, and then the rest are smaller spec plays. And then there's another one, URNM, which is even more diversified. About 30% of the top two, also has a 9% weight in SRUUF, which is basically just a pure play on uranium if you don't want to mess with the miners. So you could make the case that SRUUF, which is basically I believe it's over the counter because it's a Canadian ETF that you can buy over the counter, SRUUF, if you don't want to mess with the miners and just more of a pure play on uranium prices. As I mentioned in the pre-market notes, there's a lot of stocks on my shopping list as well. Ones that I am down in, looking to dollar cost average into, and also something like an NVIDIA that I view as, the more washed out it gets, the more I like it for a longer term hold. But while cloud stocks are certainly due for a bounce, the dynamic at play doesn't seem like it's going to change this year. So I do think energy and materials will remain leaders in this inflationary environment. And so I am looking to add some energy and materials exposure. One of the best, nuclear is, arguably the best clean energy out there. So, we saw a big run in the space here after Russia invaded Ukraine, and it just became a big momentum trade that kind of fell apart here in recent weeks as the whole market kind of rolled over. I'm tempted to buy CCJ because it is the premier stock to own in this space, but from the valuation perspective, it isn't necessarily that attractive at over 20 times EBITDA estimates, which for a miner is quite rich. You can buy a lot of the best oil and gas companies right now are at under 10 times. But again, it's like the premier nuclear energy uranium asset out there in terms of a uranium miner nuclear energy stock. So they've gotten crushed here in recent weeks, and now they're finally putting in a nice bounce today. So I didn't necessarily want to chase it here this morning when I posted that comment, but as I mentioned in that comment, ideally you could do a little basket, maybe CCJ, URA, which is the more diversified one, and then some SRUUF, which is just the uranium price itself, and maybe even NXE, which is a more speculative one. But yeah, I think it's reasonable to assume that, unless inflation really starts to cool off and the Fed is able to back off a little bit, which doesn't seem like it's going to happen, especially with the war in Ukraine not going away, the China lockdowns not really going away, the Fed's not going to back down. I think it's reasonable to assume that energy and materials will remain the leaders here heading into the summer and for probably the year.
For what it's worth, I think CCJ looks really attractive on the weekly chart. It looks like I know it has come off from its high. However, as far as a charting structure, you've got higher highs and higher lows. It's dipping right around the 50-day moving average. So I would definitely keep that one on the radar. It does look pretty good to me. So you're looking for a little bit better than where it's at right now. You don't want to chase it up 8 or
Yeah,
10% or so.
I agree, Jim, and it's worth noting I'm obviously not an expert on nuclear energy, and while I am kind of part of me prefers something like URA because of the diversification that it gives you. CCJ, again, it's the clear leader, it's the go-to. Not necessarily attractive from a valuation perspective, but if you do look at the chart on the daily or the weekly, you'll see that it did make a new high here in April and now kind of quickly crashed down, where the URA did not make a new high and that recent peak. The April high was below the high from November of last year. Because it does have a lot of the lower, like half of it is lower quality spec names. So, if this really does turn into a big bull market, then maybe those speculative names will outperform even more. But yeah, technically the CCJ does look better, and I kind of view it as attempting to play the momentum. So I do need to respect the technicals even more, because it's not like I have a ton of conviction in any of this stuff. So yeah, CCJ does look good. I was tempted to get in on that run here that we saw this spring, and I didn't want to chase, and now we've seen the washout. So, it's still below its 200-day moving average. So it does look like a decent entry here.
Well, I wish Blue Chip Trader was here to verify this, but I do remember him telling a story that he had this dream that CCJ just like rocketed up and he made tons of money and retired off it. So I don't know, maybe it's a prophetic dream. I do know that Gavin has been involved in CCJ. You no longer hold this one, do you, Gav?
No, I don't. I had bought this one. This
Like in
one's in
the
December
15s or something, right?
2020. I think no, December 2020. I bought it when they were basically talking about the U.S. needing to stockpile uranium in 2021. So that was my buying thing. But I like Craig's call on this, and I did miss out. You guys are saying that you wouldn't be chasing it here. Did I get
Well,
that
no,
right?
I just, I'm just talking from an intraday basis. I kind of, when I had posted that comment, it was kind of just going straight vertical. It was up 10, 11% on the day. So it has pulled back a little bit. But yeah, I mean, stepping back from a longer term swing kind of investment position, I do like it here.
Yeah, no, I'd agree with you there. I'd like this off that 20 psych. A lot of good things. The one thing I always find with them is they got that cigar lake up in Canada that always seems to be getting water in their facilities. So that's the only thing that I'd be keeping an eye on from an operational standpoint. But I like that call with the
Yeah.
testing 20 for sure.
Yeah, Gavin, and that's why I would almost prefer to go URA or even the URNM, or even the SRUUF, which is just based on the price of uranium itself, because of that company specific risk. I mean, I would hate to get burned, or even because the valuation isn't super attractive. It's a little bit more conservative to go after a basket rather than pick CCJ. But odds are, if a bull market in this industry continues, CCJ is probably going to be the leader, right? So
Yeah.
All right, I think this is a good opportunity to bring in Scalp Trader now. Damon, how have you been? Damon, are you with us? Perhaps we've lost Damon. Well, as we get him trying to get back on here, actually have
Came in the room. Is he muted right now? You didn't mute the other guys by accident, did you?
I haven't muted anybody. I'll let him know offline here. Anyway, Chart Trader, I actually do have another question for you. You got involved in the
That's right.
SARK, and you shorted it, which is technically being long Kathy Wood, right? So
Yeah.
anyway, so lay out the dynamics of that trade, because you don't dabble in individual equities that often. You've done it, but it's somewhat rare. But when you do, you seem to find some real gems. So walk us through this one.
Well, first of all, it's not an individual equity. I look at it as a side of the market. So it's the long duration tech plays. So we've had this kind of dynamic where you can look at sort of like a rotational paradigm over the last 6 months to a year, where long duration assets and in either the last strategy meeting or the one before that, we talked a lot about how interest rates impact this notion. So you've got companies that are big speculative bets. They've got huge long term growth prospects, but they're losing billions of dollars right now collectively in that portfolio. They're worth billions of dollars, and they're losing collectively billions of dollars right now. But the idea is they're going to make just crazy amounts of money in 2030 and beyond. And that's a great bet when you have 0% interest rates, because there's no opportunity sacrificed to get easy money or risk-free free money. So you've got a lot of money, you've got really cheap cost of leverage, and you can invest in all these things. And when interest rates started to shift and people started to realize that we were shifting the paradigm around interest rates, these things just started to get destroyed, because again, everything's the duration starts to pull forward until you get very immediate. And one of the ways that I put it in one of my notes columns was basically It's the transition from tell me the story to show me the money. And we've gone through that transition, and these stocks have been murdered. But yesterday we came in, and my sense was, and it had to do with something kind of inside baseball with the yen and how that played into interest rates. But the simple sort of 30,000-foot view is this shift from inflation shock to growth shock is kind of one of the shifts that we're flirting with here. And people maybe start to position for, even if rates don't move down right away, that a move down in rates on a second derivative basis. And that's a really important factor too. The second derivative basis doesn't mean the 10-year needs to dive. It just means people extrapolate. And if you're trading ARK and institutions are deciding what to do with stocks like that on the basis of thinking, you know, some weeks ago, 10-year was at 2.5%. A few weeks ago, it was at 2.8%. Then suddenly it's at 3.2%, 3.4%. And the extrapolation comes into the future of, 4%'s out there, 4.2%. And living in that world where that's the curve that you're living on. And suddenly that curve shifts and it's maybe we drop back to 2.5%. 2.3%, and there's a different paradigm coming in. Maybe we've seen peak inflation. Maybe we're heading into recession. That's a shift. And that shift with how oversold that ARKK is, and with how much volume we've seen come in this week over the first 3 days of the week, it's just been, like 210 million shares over a few days. And it's just way beyond anything that's ever transacted in that ETF. So this kind of capitulatory kind of transaction volume going on. I think 34 to 36 area in ARKK has been like 3 different major lows. If you include this one, we'll see where it goes. But it just all kind of added up to, it's a relatively safe level to take a shot at this after it's been so murdered. And the sort of defensive way to play it is to short SARK rather than to buy ARK. Because if you get just this choppy sideways move, SARK is going to go down. And that's something that Gavin and I discussed in detail in our last Sentiment and Flow show, and I've written about a lot on the site. With leveraged or inverse ETFs, you have this dynamic where there's a decay simply because of rationalizing the closing prices for each. So if it just goes from 35 to 37 to 35 to 37 to 35 to 37 over 2 weeks, SARK is going to go from 80 down to 65 just on that basis alone. So it kind of gives you this sense of I don't even need ARK to bounce that much to make money on SARK short. The trade-off for that is if ARK just goes straight up, you'd make more money long ARK. So it's sort of a conservative way to play this, because if it actually levers up along the way. You'd have to keep adding to your SARK short to keep up with ARK long if it just goes purely directionally. So it's more likely to win, but it's less likely to win huge if it is a huge turn. But it's the position that I took, and it's working out spectacularly so far.
Brett, I just love the irony too. The people that were shorting Kathy Woods are now being shorted.
Yeah, right.
I find it very, very entertaining to see that, just because I always get annoyed with the SARK thing, just because there's really not a lot of thought to it outside of them thinking that somebody else is dumb, which I suppose maybe that's the thought. But I love the irony that you went after them and shorted them.
Well, Brett, you've made some pretty nice profit. Would you buy it back at the 50 day? Would that be your target? 55-ish? Are you still there, Brett? I think we lost Brett right when he was giving us a price target. So we'll get him back on. Let's check in with Damon. Let's see if he's working. Damon, how are you?
Can you guys hear me? Okay?
Can you hear me?
Yes. All right. So Damon, let's put you on hold
would I buy
quick.
SARK back real quick?
Yeah, just
what do you mean?
I was looking for a price target on SARK that you would
SARK,
cover.
yeah. So I'm not looking. I'm looking for one big further extension to the squeeze in ARK, and then I'll probably cancel it out.
Fair enough. All right. So no levels, just price action, and
Price action.
We'll be all over that one when you do decide to do anything in SARK. All right, now Damon, you are up.
Oh, hey, sorry for the technical difficulties there.
That's all right. As long as we got you back up and running, we're good. So you've been, I'll say, somewhat quiet in the activity level, Damon. you've been noted to say that there's been some two-way trading action. So, what are you seeing? What are you waiting for? What are some ideas you got?
Well, yeah, I guess one of the reasons I've been really quiet is that's kind of my way of hedging or essentially shorting the market, right? It's just like my approach is I've as I look back over my performance over the years, like I just haven't been that great at shorting, and all of my performance, most of my performance has come on the long side, the distress side, the volatility side, momentum side. So, when I look at that and think about, I guess, where I shine, I'm really trying to focus on those areas. And I think that you guys have done a fantastic job with the shorting, the short ideas, calling out opportunities in the market, chart and event in particular. But for me, like I probably over the past year, I've looked at the market as just being completely overvalued in every asset. And I've said this a number of times. So the first time over the past year where literally every asset class looked overvalued to me since the internet bubble. So I've just kind of pulled back, just kind of waiting for opportunity. I played the game, tried to wait for pullbacks and play bounces because that had been working. Hasn't worked this time, so I got punched in the nose on some things. But again, I've probably 85% cash. So I'm playing with smaller size and not overcommitted to playing these balances and these really speculative names. Now, one of the things I'm starting to see is we finally reached a point where I think there are some interesting valuation opportunities out there. Yesterday I mentioned Robinhood as a name I was paying attention to, and then overnight it was reported that the CEO and founder of FTX, which is a cryptocurrency exchange, accumulated approximately 8% position in Robinhood. I think Coinbase, well, it rallied like 50% off its lows yesterday so far. But Coinbase was a name that was starting to look interesting. But I guess my point is that we've shifted from an environment where everything was completely speculative, and I feel like you literally had to be insane to be able to look at a stock and say, oh yeah, this makes sense at 30 times EV to revenue, right? Like 40 times EV to revenue. What we've been engaging in over the past year and a half has been complete speculation, and you really can't call it investing. And I think after this pullback, you're starting to see signs of interesting valuations. We're not there yet. I mean, I think we're there in terms of you'll start to see some takeovers, but not on a broad basis, not a broad scale, because valuations are still relatively high for much of the market, but you will start to see companies dip their toe in the water and start to make acquisitions. So one of the things that I'm really starting to pay attention to is the convertibles market. I tend to really like high yield and I like income. I like blow ups. I like the opportunity to buy something at a 50 to 75% discount to par, buy a lot of it and sit on it and try to capture 100% rebound, 150% rebound, and 20 to 40% yield. And so, I mean, I'm still sitting on a bunch of that stuff from the COVID collapse. And so with that, you buy it once and it's the gift that keeps on giving for years and years and years and years. So I think in the convertible market, you're seeing some of these some of these companies are losing so much money. I mean, it's insane. A lot of them did convertible offerings over the past 18 months where they're literally able to borrow $1 billion overnight at an interest rate of 2 or 3%. So that is going to be an issue because these companies are burning through that money really rapidly. And there are a lot of companies that are going to have cash needs in the next 6 months to 12 months. And some of the stocks that you're seeing really take off are the ones that are coming out like Rivian and saying, hey, well, we don't need to raise capital for another, I think Rivian said they're good until 2025 or something like that. There are several other companies that address that on their conference calls. And those are the some of the biggest runners that you've seen. But as I've started to do research on some of these beaten down tech names, the cash burn rate is so high that I mean, a lot of these companies are going to be in distressed territory, a distressed situation where they're begging to borrow money within 6 months. And so I think this is going to open up probably the most attractive, biggest distressed period that we've seen in a really, really, really long time. Maybe since the I mean, obviously it won't be to the degree of the financial crisis, but there are a lot of tech companies out there that are burning cash. There's no interest in allowing them to borrow money at this stage, and they're going to be basically at a point where either they're going to have to file for bankruptcy, they're going to have to be acquired, or yeah, there's really not a whole lot of options for them. So there's going to be opportunity there. So what you start to see in those situations is shorts will fade those names really aggressively. They'll look at the balance sheet and say, there's no way out for this company. And they'll start to fade those names, try to push them under $1, get them delisted, and then kind of create that death spiral. And so you get a lot of times with those types of situations, though, those are the most compelling squeeze setups where you can get 100, 200, 300% squeeze on these names in 1 or 2 or 3 days. So that's one of the areas I'll be paying attention to. I've done well on in the past with the convertibles. A lot of them are trading down to the 75 to 80 cents on the dollar range currently. As we move further further into the year, these companies continue to burn money. There's concerns about liquidity. I think you'll see those bonds move down to the 30 to 40 cents on the dollar range. And so then you start to identify the names that have attractive IP or attractive or compelling brands that someone wants to buy, even though they're burning a lot of cash, someone else wants to own them. And then there's the opportunity for those bonds to return to par once the acquisition takes place. So those are a couple areas that I'm really paying attention to: the beaten up, distressed, squeeze momentum trade, as well as the convertible trade, convertible kind of takeover trade. And one of the nice things about them, yeah, again, like the convertibles, is that you buy the right one, you might be able to double, triple your money, as well as lock in, really strong yield. So also, I like high yield. That market should be starting to come back any minute. The rates that are required to do a deal right now are off the charts. So I think companies are just stunned by what investors are demanding. I mean, I think you'll start to see some high yield preferreds come to market in the 10 to 12% range, possibly higher. I mean, it's tough to borrow money out there right now. So things get really interesting over the next 3 months once companies are really understand just how much their backs are against the wall, how desperate they are to raise capital. Some of them are just going to have to just go for it and take money at any price they can get it.
All right. I think that pretty much covers what you wanted to mention. Is that fair assessment, Damon?
Yes, it does.
Okay. All right. Chart trader, you had a parting shot. What do you have for us?
Well, I just want to say that over the years, I mean, really, we're almost decades now. Scalp and I tend to have this sort of yin and yang relationship, a complementarity, where I see what's about to become distressed and hammer it down, and then he monetizes the hell out of that opportunity the other way. And you can see the pattern emerging right now, and it's just like he just talked about. Like, we're getting to a point where we're going to start to see things that he's going to be able to monetize the other direction in a huge way, and I'm going to start to be looking for different types of opportunities. So there's this yin and yang there, and I think that we're getting closer and closer to that point.
All right, but safe to say it's not there yet.
I don't believe it's there yet. To me, there's still going to be short follow through for something that's a little bit, something's going to break. I still I said that earlier. I think that you can't have this kind of interest rate paradigm shift without there being some body somewhere that will eventually float to the surface, and it's going to be that next kind of point, and then we get to where it's really going to be Scalp's party.
So I do think it's safe to say we are all kind of expecting further downside overall.
Yeah, I haven't seen like the liquidity issues that you typically see in kind of a bottoming process. Typically, people are trying to sell everything, get out. I mean, you're kind of seeing that in crypto. I don't know if you guys have been following the story of the coin. What do you call these things?
CoinDesk.
What is it?
Well, there's
Coin-
been a few. There's been a few coins that blow up, right?
You're talking about the SEC disclosure for CoinDesk, or the drop below the one on the one stable coin, David?
Yeah, the stable coin that went to, I think it might be trading at 25,
Tether.
30 cents
Now,
now.
I thought there was more than one over the last week.
Well, Tether, I think, broke below $1, maybe down to 99 cents or something after this other one that's tied to Luna, and I can't remember the exact name of it, but it went to, I think yesterday when I looked, it was trading at 33 cents, and it was supposed to stay at $1. So I think that had 10, $15 billion in it. So I guess my point is that's the type of liquid. I mean, obviously not to that extent, but you want to see something like that in the equities market.
Yeah,
that freaks
or credit
people
markets
out, and they just want to, run for the exits, and
Well,
you haven't really seen that yet.
It'll be an interesting dynamic, because the one thing that's allowing the Fed to kind of press forward right now is the idea that we haven't seen any financial instability. I've been saying for years here, if we're going to get any financial instability, it's going to be in the fintech area, because it's not regulated, names like a firm and things like that. But we haven't seen anything along those lines. But I guess that's why I'm kind of still cautious in the idea that we've been trending down. Sentiment's been pretty poor, but we really haven't had economic data or earnings data to back up the moves that we've seen in terms of something completely falling off the cliff. Certainly more in-line reports going on, and some cautious tales about the outlook. We certainly saw that from the banks at the start of earnings season. But I kind of want to see some of those data points really start sticking in. That's why I'm so curious to see, we've had such a slowdown around China. What happens in June and July when we start seeing that slowdown really kind of have a bigger impact on the overall broader numbers? So that's kind of why I'm still remaining cautious. And then we could start getting the flush out, and the financial instability maybe starts taking a little bit more hold. But I'll be curious to see how the Fed pivots around that, if that does start occurring. So,
if I may, the turtles aren't completely in their shells yet.
Right.
Yes.
We're gonna get there, and then when they are, it's gonna be great the other way.
Yeah, the one thing that I have seen is, I think this week or last week, Upstart, which is supposed to be basically kind of a technology company that's basically using AI to match borrowers with lenders, couldn't get rid of the loans that they issued this past quarter. So I think they got stuck with like $500 million worth of loans on their balance sheet, and that's why the stock blew up. So you look at some of these companies that are out there that are saying, "Hey, we're just tech companies and we're using AI and we reinvented the wheel here." Some of these companies could get stuck holding the bag. So I mean, that's an area to really pay attention to. Like, I was looking at, I was just researching some of these names, and they're really lending pretty aggressively. And so, some of these companies are going to blow up.
Even CoinDesk falls into that, Damon, where they were talking about 54% of their users on their platform now are using the platform for other areas, and part of it is staking people, and crowdfunding, things like that. That's going on. That's just not being regulated, like you said. I mean, fintech's always, for me, been the area where we're going to see this issue. And like Damon's saying, you got people that are moving into the areas that they really don't have quite the understanding. And perhaps more importantly, and this is why coin got hit they don't have the financial backing. They don't have an FDIC approved that's going to save these lenders from 250,000 in losses or whatever. And that was the disclosure that CoinDesk put in that sent everybody into a tizzy. And you could just see how that thing could really snowball, like Damon's talking about.
You
if
can see
things
the
start to
feedback
go
loop,
south.
right?
Yeah,
You can see the feedback loop there, because as the environment worsens, it gets even harder.
exactly.
Let me just come to the defense, if I may, to upstart a little bit. Damon, I did post a comment about that this morning, trying to defend it. So yes, they have almost 600 million in loans on their balance sheet, and the whole point of the company is, we don't do that, right? We are just a tech platform. We're not a bank, and that is still largely true. It went from almost 600 million to like 250 million in the prior quarter, and three quarters of that is from testing out their new auto products. So before they really train rampant and scale the business, they're kind of testing it and training their models, and they are holding those loans before they go all in on their whole business plan. So there was really, if you do the math, there was 87 million in loans, 2% of what they originated during the quarter that they ended up holding. That wasn't part of just incubating their new auto financing business. So yes, I mean it's a black eye, but if you think about what was happening in Q1 and some asset-backed securities markets kind of froze up. So it made them look really bad. I think it's mostly the fact that they just didn't manage the expectations well at all. But at this point, I mean, they're, when things do cool off, this company does have a great potential to keep growing profitably. And it's right now the stock is trading at like 15 times earnings. So yes, it's viewed as like a canary in the coal mine and all that high, it obviously never deserved to be at $400 a share, but I do like it here. Again, I could be wrong, but the model is to not hold the loans. They are going, they did last quarter, and they will continue to incubate, not only to scale this auto financing business, but they're also going to move into small dollar loans and loans for small businesses. It's definitely going to be a controversial stock, but it's heavily shorted, high growth, high margins, at a very reasonable market multiple at this point. So I do like it for what it's worth.
All right. Did you have a question about oil, Craig?
Yeah, I just wanted to hear Brett's thoughts on oil from here. I know he was kind of calling for a flush below 100. And I was kind of expecting that myself, given the growth concerns that were coming, and that could certainly happen here this summer if things do get uglier. But the fact that it is holding up so well seems to be quite bullish. The bull case on oil, obviously the geopolitical issues don't seem like they're going away anytime soon, and the domestic production issues aren't. I mean, nobody's really ramping production, so I'm assuming that the bull case is kind of still there, and Brett is just kind of patiently waiting for another setup. But I'm just curious whether I'm assuming right now that this isn't a typical. Well, oil. This isn't just a little cyclical scare, but there could be legs behind this move, which is obviously something that I'm, trying to analyze if I do want to add energy exposure.
So I can have an awesome time debating myself about oil, which is why I'm not doing anything. I can see two very different pictures. I can see also different pictures over different time frames. So I think that there's a couple things. One, I have a hard time buying because I think that there's going to be a problem, and the problem is going to be people start to realize where this picture really is, and a lot of sanctions around Russian oil on I guess I believe in my heart are going to start to get peeled back, especially if we are really heading into a stagflationary environment where one of the big problems that's causing nothing to work right is access to energy because it's just so undersupplied. It's been so underinvested in for such a period of time. And if we head into a recession and then suddenly, you know, people start to say, we need Russian oil too, it's really going to melt down. But so it's really, but we haven't done that yet. And Europe could still come out and say, you know what, Hungary, you don't have to do what we're doing. Each individual country is going to decide this. We're going to abstain from Russian oil. And we're already in this undersupplied situation. And so you see this huge squeeze. So it's really, really hard to play over the near term. So I'm just leaving it alone. I'm watching it until it starts to do things that I think make sense given that picture. But the very long term, really looking out a ways, I don't understand how we're not going to see like $300 a barrel oil at some point because nobody's going to invest in new production capacity. And we've underinvested in it for the last 15 years. And we're doing this transition away from fossil fuels, which I'm 100% behind philosophically. But the transition is going to be a bumpy process. And we're going to get to the point where, there's such the game theory landscape is really bad right now that nobody is going to invest in big new production capacity in oil, even though they could, and it's there. There's just so much disincentive because you're talking about you'd be setting up something you plan to profit from for the next 50 years, and yet we're transitioning away from fossil fuels over the next 10 to 15 years. And so those huge, commodity resource development investments are not like other fields. It's billions and billions and billions and billions of dollars, huge infrastructure, massive capital has to come together, and it's a very long-term bet, and it takes 10 years to play out until you're really chugging along. And we stopped doing that 10 years ago, and we're already starting to feel the effects of that, and there's going to be no more of it where fossil fuels are concerned. And so how do we get to where the transition where that just starts to drop off and we're just undersupplied and we don't have the ability to really fulfill the energy needs of the world without it? And so I just see this terrible period 5 to 10 years down the road where oil is $350 a barrel and we're going through an energy crisis, and it's really depressing to think about. But I don't see how it doesn't play into that. But at the same time, then if you're looking for a secular investment theme, sure, that's it. People who own the oil. But over the very near term, if we start to say, you know what, the pinch is too tight right now, we are going to find a way to make it politically palatable to allow Russian oil to saturate the world market. And when that becomes something that's established, I think this really dives for a bit.
All right. Well, I'm not looking forward to the gas prices at that point, Brett, but I guess we'll wait and see for
Sorry.
that one. Yeah, maybe we'll all have electric cars by then. It won't matter. Of course,
Hopefully.
then they'll raise the rates of the electricity. So,
Well, it's going to bring copper into it. We don't have enough of that either.
Yeah.
Damned if you do, damned if you don't. Isn't that right?
I guess.
All right, Brett. So anyway, is there anybody else that has any other parting shots we got to address?
No, I think I'm good on my end. I speak
All right.
enough. People know what I'm thinking, I suppose.
Yeah, and it's always good. I love the interaction that you guys had with the questions back and forth. That always makes for a good program. So, as always, gentlemen, I want to thank you guys for joining us today. Thank our listeners for tuning in. And guess what? We get to do this all again next month. So, looking forward to that. Thanks a lot, guys.
Thank you, Jim.
Thank you, Jim.
All right.